Opinion: the Fed's decision to increase interest rates this week is absurd. On Wednesday, the Federal Reserve is preparing to raise interest rates once more. That would be erroneous. It's time for the Fed to take a break after an extraordinary year of rate increases. After the pandemic, the Fed made a mistake by waiting too long to start normalizing interest rates. Overheated inflation was the outcome. Given the extraordinary uncertainties that COVID-19 and Russia's war in Ukraine created, it is unfair to be overly critical. But it will be their fault if Fed officials continue to make mistakes, raise interest rates, and start a recession. The Fed is moderating even as it recognizes that controlling inflation is its top goal. According to Moody's Analytics, consumer price inflation, which peaked at 9% on a year-over-year basis last June but has since moderated to 5%, will be just over 3% by the end of this year and will be at the Fed's 2% objective by spring 2024. Although this forecast is uncertain, it is more certain than it has ever been since inflation began to soar. The slowing down of housing expense increases, which makes up the majority of household budgets, is the thing that is most definite. Due to the large number of leases that only renew annually, market rents have a lengthy lag when it comes to influencing housing expenses. As more households began renting after the economy recovered, rents rose, the number of new rentals was constrained by labor supply and supply chain issues brought on by the pandemic, and vacancy rates decreased. The result was a significant increase in housing expenses. But in recent months, the average rent has started to fall, and rental supply has increased as labor and supply chains return to normal. This year will see the completion of a record number of multifamily apartments that are now under construction. Demand destruction also occurs since many potential households cannot form due to the high cost of rent, despite the fact that rents have begun to decline. Instead, young people choose to remain living at home. In the upcoming months, lower rents will result in significantly slower rise in housing costs. Prices for cars and trucks, which have risen sharply since the outbreak, are also expected to decline. Weak new vehicle manufacturing, particularly in Japan and Germany because of supply chain issues related to the epidemic, has driven prices globally. New vehicle prices increased as stocks on dealer lots shrank. Due to a shortage of used cars due to the limited availability of new cars, used car prices have increased even further. However, as global producers adjust to the disruptions caused by Russia's war with Ukraine and supply chains finally get back up and running after China ended its zero-COVID policy earlier this year, global vehicle production is picking up, and inventories are growing. Manufacturers and dealers will soon be under pressure from the competition, offering greater incentives and lower pricing. The persistence of inflation for non-housing related services is the hardest to measure. Price increases in a number of labor-intensive service sectors, including healthcare, hotels, and personal services, are reflected in this so-called supercore inflation. As higher interest rates have an adverse effect on labor demand, the Fed is particularly interested in supercore, which most clearly reflects labor costs that monetary policy can influence. Even while supercore inflation is still uncomfortably high, the trend lines are positive. Businesses are reducing hiring as a result of the Fed's aggressive rate hikes, which are beginning to erode labor demand. In fact, my own study reveals that for the first time since the epidemic shutdowns, labor demand has slipped below labor supply. The strongest indication that wage growth has peaked is the fact that, although it is still too robust to be consistent with the Fed's inflation target, it isn't too far off. The Fed would be wise to place more emphasis on making sure the banking sector is stable when it considers more rate hikes. The government's forceful action, including the emergency liquidity the Fed gave to the banks and the seizure of the most unstable banks, was the only thing that could stop the banking crisis that had gripped the country since mid-March. It is contradictory for the Fed to assist banks in raising capital at the same time that it raises interest rates, increasing the cost of that funding. Even though the crisis seems to be resolved, the effects on the economy have only started. Batten down the hatches for chastened banks with reduced capital and limited liquidity. They're planning to restrict lending requirements even further, which were already getting very strict. The tightening will be more noticeable for commercial real estate that is particularly hazardous and for company loans for commercial and industrial purposes. The most affected will be small firms, which depend on small and mid-sized banks for loans. The probability that inflation will return to the Fed's objective is rising. Job availability is improving. The financial industry is vulnerable. All of this suggests that the Fed should stop raising rates. Investors have even factored in a big monetary policy easing that will start this summer. That would be in line with the gloomy predictions made by the Fed's own economists. In fact, the Fed staff economists now forecast a modest recession commencing later this year, according to the minutes of the March Federal Open Market Committee meeting. I'm not as pessimistic, but the Fed needs to stop raising rates in order to avoid a recession. If the Fed raises rates, the economy probably won't suffer. Why then take that chance?